It's Jim Turner here again with Biz Val Guy, and today I've got a couple of potential investors and a couple of friends that I know from church, and we're going to talk today about a topic that a lot of people are interested in, and that is simply to learn the ins and outs of business valuation. And so we'll start right there. Brady, do you or Wes have anything to add to the conversation as we get started?
No, I think interested, like you said, Jim, to learn kind of the ins and outs of how you look at evaluating a business. I think also from the perspective of if someone is buying a business, it would be interesting to understand sometimes the multiple on the equity or on the EBITDA obviously plays a big role into the valuation. And so the effect of when you're looking at a business, even to understand what that multiple should be, like how is that determined, and if it's possible to change that over the life of the business would also be interesting to understand.
Yeah, that's a good question, and I will. Now that you pointed that out, I'll make sure I answer it. And if I don't answer it at some point, then remind me, please.
Yeah, sorry to throw that in at the last minute there, but I think that would be helpful. Yeah.
Well, fortunately, I've done some research on multiples over time, so I've got some insight that won't just be coming from off the cuff, but I've done some research and presented on that before. How about you, Wes? Do you have any specific items you want us to cover today?
I don't think so right now. I'll probably have questions as you know me over the course, but right now I'm good.
Okay. All right. So the first part of the question and what we're going to try to do today is the ins and outs of business valuation. So we'll start there and simply to learn what they are. So to begin with, I would say that cash flow is much more important and much more of a catalyst to business valuation than any other metric. Like if you think revenue or any other metric, they're going to be secondary to cash flow. And when I talk about cash flow today, I'm going to be talking about EBITDA, EBITDA. And EBITDA, Brady and Wes, you probably already know this, but if anybody's watching this that doesn't, means earnings before interest, taxes, depreciation, and amortization. So, and then there's another metric that you'll see a lot on websites like Biz Buy Sell and other brokerage-centric websites where folks are trying to buy businesses or sell businesses, and that's called seller discretionary earnings. Some people may call it discretionary earnings or owner benefit. And what that definition is, seller discretionary earnings, should mean earnings before interest, taxes, depreciation, and amortization, or EBITDA, plus one owner's compensation. And so that should be the definitions for cash flow. But today we're going to be talking about EBITDA, earnings before interest, taxes, depreciation, and amortization, because that, as a professional business valuator, that is a much better metric than seller discretionary earnings. Seller discretionary earnings can be a good metric for micro-sized businesses, but ultimately you need to be able to corroborate the results from the market approach with an income approach. And often, if you are using a seller discretionary earnings multiple, you will have difficulty sometimes with the justification of the value, because the income approach will basically point out that you're not really reasonable with the valuation or with your appraisal. So that's going to be a good thing for us to talk about today. So I'm sharing my screen on a valuation that I did several years ago called, this is redacted, All-Star Equipment of Gotham. So if you're thinking Marvel or whatever, Batman.
I like it.
So we got, or Superman, we've got Clark Kent, First Kryptonite Bank, and the U.S. Small Business Administration. So this was a buy-sell scenario. It had already been through underwriting. The bank came to us. We're kind of like the final stop in the process. And the bank, we're on a lot of bank vendor lists, preferred vendor lists, and they send us valuations to do on deals that are about wrapped up, and now they need the final seal of approval. Sometimes they come to us beforehand, but often it's at the end of the process after underwriting's already looked at it. And so we got this valuation that we did a few years ago, and we're going to take a look at it today. But so EBITDA is the cash flow we're going to be looking at. And the biggest in and out I would tell you is that cash flow is king and EBITDA is cash flow. And so over a lot of our lifetime, especially mine, maybe yours, Brady and Wes, we've all heard at some point that cash flow is king. Refers to a lot of different things like, when you're in a financial crunch, cash flow can be king because you might not be able to get credit. Well, in business valuation, cash flow is king as well. So I'm just going to continue to scroll down through some of these initial pages. And we ended up with a value of $2,030,000 on this assignment. And I'm just going to turn over to the financials because that was a question that came up, is what financials would be used and which ones would be ignored. So the ones that would be used is we're going to use the balance sheets. So, and I'm just showing you my screen right now. Here is a snapshot of 3 years worth of balance sheets. And we got this from the federal tax returns. This was an 1120 S Corp. And so we extracted this data from the S Corp return, and we got cash, receivables. There was no inventory. This was an equipment rental business. And we have a lot of fixed assets because a lot of these fixed assets are really rental inventory. And we have some intangible value as well. And then you can see the long-term debt and the other side of the balance sheet there. And then the other really foundation of any business valuation is going to be the income statements. And again, we extracted these from the federal tax returns, the 1120Ss. And my thoughts are, I would prefer to use the federal tax basis information if it's available, because this business owner had to submit that to the government. And I believe that if they are willing to pay taxes on these numbers, then they're probably accurate, because there's the motive on the part of the owner to actually make these numbers lower, as low as possible. So I tend to go with either the federal business tax returns, or if the financial statements have been compiled, reviewed, or audited by a CPA firm, I will utilize those. You mentioned like what financial statements might you not look at? Mm-hmm. The ones I put the least weight on, I'll look at anything somebody gives me, but the least weight I would put on is something that the owner of the business has prepared themselves. Like if they use QuickBooks and the owner or the owner's spouse or the owner's children or whatever have prepared the QuickBooks, then that I'm going to have the least amount of faith in that particular set of financial statements than any other financial statements. Third-party financials that I mentioned earlier are going to be where I put the most weight, and those going to the IRS, especially if that business tax return has been prepared by a CPA, then I'm going to put even more weight on it because it was prepared by a CPA and it was sent to the IRS. So any questions there before I move on?
No. So is it primarily then, like, would you dig deeper for certain businesses? So I get the balance sheet and the income statement. Like, are there other kind of peripheral, let's say, financials, I don't know the right word, that you would also look at, Jim?
Yes, I may only look at the balance sheet and the historic income statements and present those in the valuation, but at some point I would probably also dig deeper and maybe if I were buying a business, I would want the general ledger for these 3 years, and I would probably ask for monthly P&Ls for these 3 years. So I would want to see from like January 1, 2019 through December 31st, 2021, monthly P&Ls, and I would put those in a spreads or a spreadsheet, and I would look at trends, and I would start to identify, any anomalies. I would make notes about it. So that's a great question, Brady. So I would definitely get the monthly P&Ls, and if necessary, if I need to drill down even further, I would ask for the general ledger detail for all 3 years, which the general ledger detail is going to show every transaction for the 3 years from January 1 until December 31 of each year. And so for a business of any size, that is typically going to be anywhere from 25 to hundreds of pages long. So because you're going to have a lot of transactions running through it, but it can be worth your time to have the general ledger detail, especially if something's not quite synchronizing, like the monthly P&Ls don't synchronize with the business tax returns, or the financial statements don't synchronize with the business tax returns. If something, or if the potential seller is wanting to add back some things that you need to trace to the general ledger and say, okay, I understand you want to add back these expenses that with this person, they could have leased equipment, or they may have used some of their equipment that's normally for lease to, say, do a home addition. That's a common thing I hear. Hey, you know what? I used some of my equipment, or I paid for a home addition out of my business. And I ran it through my P&L. It's in my cost of goods sold. And so when I'm evaluating a business, if I really want to drill down, then I'm going to be asking for general ledger detail, so I can see the detail behind of any potential normalizing entry or add back, is what you may hear it called, that is not really, it's not easily identified, and it's not easily proved either. So I'm trying to trust but verify when I'm thinking like that. So, but any other questions?
No, I think that answered that. Yeah.
Yeah.
I mean, I'm sure I'll have more, but
yeah. Well, the questions are great, because I'm sure someone watching is going to have the same question. But you'll notice that what you see here with the P&Ls is that they were pretty similar in 19 and 21, and then during 20 that it dropped off revenue and net income, and that was likely because of COVID. I remember this valuation when I was analyzing it. It was a COVID thing. They rent equipment, so at least at some parts during COVID, there wasn't a lot of rental of equipment being done because people were shut down. It did pick back up robustly at some point during the latter part of 20 into 21. So that's the kind of the overview of some of the financial data. And then I'm just going to scroll down to some of our analysis, like where the rubber meets the road with that financial data. Mm-hmm. So we come down and we start adjusting the balance sheet, because in this transaction, the seller was going to keep their cash, and they were also going to keep their receivables. So, and that's common in a asset structured transaction. Even if it's an equity deal, a lot of times the seller will keep their cash and receivables, but they also, the buyer did not assume any liability, so the seller had to pay off all their own liabilities. So what it is a cash-free, debt-free it's really a working capital free except for inventory and the fixed assets. Here you'll see that the fixed assets had an adjusted book value of $1,276,000. So that was being bought, and also all intangibles. And we zeroed out intangibles here because the historic intangibles to us are irrelevant, because we need to value the intangibles in the valuation. So if our valuation comes in higher than $1,276,000, then we're going to identify that there are intangible assets. So we'll scroll down past here.
What would as an example, intangible assets?
Intangible assets are
like intellectual property or something, or
your organized labor force is an intangible asset because it's not showing up on the balance sheet. I'll scroll back up to the balance sheet. So you're not going to see the organized labor force here. Mm-hmm. The intangible assets here were if I recall, it was like the purchase of another business. They bought another business and they paid more than asset value. So they had intangibles on their books. But in order to justify the carrying value of intangibles, you have to do another valuation to determine if the intangibles still have value. So, and again, getting back to your question about what are intangibles, organized labor force, goodwill, like your ongoing customer loyalty that you have with customers, repeat business. Mm-hmm. It would be trademarks, trade names, secret sauce, if you will, especially if you're a restaurant. So it's all those things that are assets, your website, that don't show up here in the fixed assets, and they're not going to show up in intangibles typically either. This business just ironically had some intangibles because they had bought another business. But typically you won't have any intangible value here. And even though we had intangibles, we adjusted it here because we haven't identified whether these intangibles, whether there are any intangibles in this business or not. We have to look at the cash flow to determine that. Did I answer your question?
Yeah.
Okay. So moving on down, we make some adjustments, and you'll hear people call these in business valuation, professional evaluators, we call these normalizing adjustments. In brokerage world, and maybe a seller might call them add backs. So we adjusted the officer's comp after an interview with the officer. We adjusted the lease, the rent on the building, because the owner owned the building. The owner of the business owned the building, and he wasn't charging any rent. So we had to recognize. So we reduced officer's comp, but we increased operating rent to recognize that, in fact, if this seller sold the business to a hypothetical buyer, but they kept the real estate, they would no longer, have zero rent. Mm-hmm. if you bought the business, or I bought the equipment business, but the seller of this business kept the real estate and leased it to us, rent would not be zero, which is what it was when this current owner owned the business. He wasn't charging rent to the operating company. So the holding company was not charging rent to the operating company. So you have to recognize that there would be an expense to the business. And then the taxes associated with the officer's compensation being decreased, those also decrease. So then we take our net increase or decrease in expense, and we basically adjust our historic income before taxes by that net increase or decrease. And so we've got adjusted net income or normalized net income of you can see the numbers here, 177.8 roughly in 2021, 34.3 in the COVID 2020 year, and 223.210 in the 2019 year. Now that's historic net income. That is not or adjusted net income. And here are the adjustments in a spreadsheet form. And I won't go back over those. And here is the adjusted, a presentation of the adjusted income statements. Now they've been adjusted. We had historic earlier directly from the business tax returns. Now we've adjusted the officer's comp to 39.5 based on what the officer presented during our conversations, our interviews, and the buyer confirmed it. The officer wasn't working full time; they were working part time, and so they were working less than 20 hours a week. And so their reasonable compensation to replace that officer, we calibrated that to 39,500 based on Bureau of Labor Statistics data. The operating lease, this was about a $1.5 million building. And so the lease we adjusted based on the expected return on a $1.5 million building. We estimated that at 118,800. So the cap rate would have been somewhere between like 7 and 8% or so. And those were the major adjustments. Let me see if there was anything else. No, that was the officer 2 to market value. There was also an adjustment. The officer had a family member working, and their salary was also adjusted to market rate. So we have our adjusted net income now, or normalized, and then that flows down to an income approach called the capitalization of earnings. And so if we scroll down and look at how we looked at the earnings, we saw that here was the adjusted earnings before taxes, or adjusted net income before taxes. And then here was adjusted interest and adjusted depreciation and amortization. So here was adjusted EBITDA. So we're back at earnings before interest, taxes, depreciation, and amortization. And we weighted 2019 and 2021 because they're so similar. It looks like that had COVID not occurred, it looks like this business has a sustainable future cash flow of about 400, and we have it at 78,000. And we just weighted each one of these equally. And so the weight of this cash flow and this cash flow, you add these together and divide by 2, you get 478. Then we have to get, for an income approach, we have to get that on a after tax basis. So we determine.
Hey, Jim, sorry to interrupt you there. I guess my brain's a little slow, but in the adjustments that you do, right?
Yeah.
So I understand you take balance sheet, income statement primarily. You look at, for this business, is there anything unique about this business, or is there anything they're doing, let's say, exceptional for their business that a new business owner might not be able to either benefit from, or it might be a deficit for them? You take those, you do the adjustments that you see as, I guess in my words, I'd say traditional across normal businesses in that type of industry. Is there anything above it? I'm trying to think of what other typical adjustments might be in there that weren't necessarily in this business. Or is there anything else that you see a lot of times that's like, oh yeah, people don't understand that this is, let's say, an egregious overstatement of value in a typical income sheet or balance sheet that is typically adjusted? Like, is there something that's like in other businesses that you just normally see that's not necessarily in this one? Sorry to jump back so far.
Well, no, that's fine. I think that's a great question. The adjustments that we normally see that the owners or the sellers are asking for, they're typical. What they've taken as a normalizing adjustment are things like travel and leisure expenses that they may have ran through the business. Also, as I mentioned earlier, a lot of times we'll see people say that they did some home improvements or something else outside of their business that they ran through the business as an expense. And so those are a couple of things. Another item that we'll see pretty common is that an owner may have their spouse on the payroll, but they're not actually working at the business. And so let's say you have an owner that is paying their spouse $50,000 a year because that other spouse is staying at home with the kids. And so in order for that spouse to stay at home to get Social Security, Medicare credits, and also to be able to say defer compensation into a simple IRA or a 401k, they're paying the spouse that's not working at all $50,000 a year to stay at home with the kids. Yeah. So what you have to ask yourself is, what are legitimate normalizing add backs and what are illegitimate? And we see both, because business sellers will typically ask for more, or they'll think things are add backs that aren't add backs. And on the other side, a buyer may not want something that is a legitimate add back that should be added back, but the buyer doesn't really want to recognize that. So, and something that somebody may not want to recognize is the fact that somebody's spouse was being paid, and it was hitting salary, but now you want to add it back and adjust it when you're going to sell your business. But that is a legitimate add back if the spouse was not involved. And so what you want to ask yourself when you're evaluating a business or valuing a business, if you see an ad on BizBuySell or BizQuest or businessesforsale.com, then you want to ask the parties, you want to say, or you want to be thinking about, from your perspective, if there's an add back being added back, you want to say, would a hypothetical buyer incur that expense or not? And if the hypothetical buyer would incur the expense, then it's not an add back. So the only things that are added back are expenses that would not be incurred by a hypothetical buyer, like the spouse that's being paid even though they're not working at all. So that's the real crux here, is that from a hypothetical buyer, hypothetical scenario perspective, that's where the normalizing adjustments take place. And does that answer?
Yeah. Thanks for that. And again, sorry for jumping way back on you there, but that helped. Yeah, that's
so. Let's just say from this point here on this page, we've agreed with all we've gotten our normalizing adjustments, and everything that's going to be added back had been added back, and everything that's not going to be added back is not added. Depreciation, you don't normally normalize depreciation. It usually is what it is. And the same thing with interest. So we have our weighted average EBITDA right here of 478. Then the 250 in depreciation is also averaged from these 2 years. It's the average. And the 250 is going to shield 250 of this 478 from state income taxes and from federal. So this business happened to be in Florida. So for any Floridians that might view this, you know that your state, you don't have any state income taxes. So there are no state income taxes being taken out of this cash flow stream. There are federal taxes, though. After the 250 depreciation is accounted for, the taxable income is going to be 227. And so here is the tax calculated. So we subtract 47 from 227, we get 180. Now we add the depreciation back because that is cash flow. When you recognize depreciation, you're not actually writing a check for $261,000. It's just an accounting recognition that at some point in the past you've spent money on equipment, and now you're recognizing it and offsetting taxable income. So you add back the depreciation here. Now we need to recognize that, you know what, ongoing, this business is going to require some capital expenditures to operate it because it is an equipment rental business. That equipment is not going to last forever. And so after talking with the owner and the buyer of the business, the seller and buyer, we all agreed that based upon the historic data, we believe the future CapEx is going to be $200,000. So the selected ongoing capacity is $230,000. And what that number is, it's not what the business is going to do in the past. It's kind of based on the past because this is a fact, that's a fact, and this is a fact. It's a fact that this business performed this way in the past. We believe that will perform at this capacity, $230,000 after tax cash flow, debt-free after tax cash flow at $230,200. And so we're going to take that number and we're going to divide it by our risk rate, which I won't get into risk rate, but at least not yet. If we want to talk about that, we will. But the risk rate we developed for this particular business, it's a weighted average cost of capital. So it's not just equity, but it's the weighted average cost of capital to equity and debt was 10.9. So if you divide 230,200 by 10.9, that's the value we came up with as the operating value. But you may recall that we're not getting any working capital with this deal. So we have to back out the necessary working capital. And we backed out 80,000 in net working capital because we used RMA data, which is a resource that we use. And it depicted the typical company with similar revenues in this same industry. $80,000 was the net working capital. And so our value is at $2,031,900 or $2,032,000. So that was our income approach, capitalization of earnings. Any questions about that?
I guess realization about it, but I'm not sure if this is the right spot to ask it. You can tell me if you want to answer it later, but so naively, right, you hear a lot about it's EBITDA times a traditional market multiple for this type of business, I guess. Yes. Would be a generic way of saying it. This is very different. You're looking at cap rate compared to basically, I guess, adjusted cash flow, right?
Yes.
So I think, how do you reconcile the two? I mean, yeah. I understand what you've gone through, but the traditional thought that you hear a lot from the Jim Turners of the world is that it's all about EBITDA and then the multiple for that type of business, right?
Yeah. So Brady, that's a great question. And I think the best way for me to answer it is to go down and let's take a look at the market approach.
Okay. Oh, okay.
That way we can see that they're complementary. They're not excluding each other. If you do have an excluding factor, like if the market and income approach don't synchronize, then as a valuator, I really start looking at both approaches and trying to figure out where the differences are.
Okay, I'm catching up with you now. So you look at both. The other was just below. Got it.
Yeah.
And so hopefully they agree or at least are somehow similar. Yeah.
Yeah. And we're going to see it. We, as a firm, we will not release a valuation from our office as complete if these two aren't complementary because we believe there's a problem. If the only time we would is if there's just not enough market data to value a particular business because it's so unique that it really doesn't fall into any industry. And that would be, I remember valuing a business that their name was basically, it was about pigs being artificially inseminated.
Okay.
And so I can't tell you the name of the business, but imagine valuing a business where your business model is you sell the insemination product. And so your
Imagine
business
there's not a
model,
market standard for that.
yeah, I couldn't find any comparables to that. I couldn't find another company that sold bore semen. So that was one of a kind, right? But most of the time, 90+% of the time, we find market multiples, and we find usually a good number of them. So in this particular assignment with All Star Equipment of Gotham City, we found 13 transactions, and our NAICS code was a code that's synonymous with this particular business. Annual sales were in range of the particular subject business. And here were our multiples. And we'll just go right to the EBITDA multiple. We found that out of the 13, the minimum, the least amount multiple of EBITDA that a business sold for was 2.58 out of the 13. The maximum was 5.08. So we see about a 2.5 to a 5 for this particular industry, equipment rental. And our median was 3.95. So mean doesn't mean as much to me as median, because the mean can be skewed by outliers. And so I typically put more weight on the median because that is the middle. Half the 13 transactions were sold above the median and half sold below. I find that to be a better number. I won't go into too much to variation, but the lower this number is, it can be from 0 and higher. The lower the number, the better. It means that the multiples are really tight around the mean. And so if you have the standard deviation is tight around the mean of each particular population data point. So you want this as tight as possible, but basically it means that the typical, like here with EBITDA, the typical data point was only 19% away from the mean, which means that there wasn't a lot of fluctuation either above or below the mean, which is good. That's what you want to see. So going down here, we used a 4.25 EBITDA multiple, and we came up with the EBITDA the same way we did with the market approach. We weighted 2019 and we weighted 2021. 2020 was an outlier. It was an anomaly because of COVID. You can see how close the EBITDA is. I mean, it's within 10% in 2019 and 2021. Yep. And based on conversations with the seller and the buyer, we all agreed that was the sustainable future cash flow. Because remember here, you are buying future cash flow. You're not buying the past cash flow. The past can be a good indication of the future. And so that's a lot of times that's where we start. Sometimes it's not a good indication of the future. So we weighted 19 and 20. 478.1 times our EBITDA multiple of 4.25. We came up with a value of $2,031,900. I believe it's the exact same number as our income approach. It doesn't happen often. I will say that. That's probably why I chose this as a sample, because I send it out to banks and attorneys and other people, and it is a great example of how complementary the valuations can be. We use the 70th percentile here of EBITDA, and which means that 7 out of 10 of this particular 4.25 is at the 70% better than most of the sample population. So out of the 13, 70% were less than 4.25 and 30% were above 4.25. We, based on what we learned about this business, and it had been in business for a long time, and it was in Florida, it was in a dynamic market, it had a lot of customers. And so we believe that the 70th percentile was a reasonable multiple for this. And so we did do some statistics to look at Again, correlation, how correlated were the samples? In other words, how well did EBITDA explain the change in sales price? And what we found was that EBITDA, being the independent variable, explained 98.88% of the change in sales price. So for every dollar of EBITDA, what this is telling us is that for every dollar of EBITDA, sales price went up $4.61.
Mm-hmm.
How much confidence did we have? You can see, or how correlated was it? When you see a line like this, the best fit line, and the data points are all along it, that is a great line. That is the coefficient of determination, or the R squared, really tight. The data points are all very tight around that that best fit line. If it looks like a shotgun blast, then the R squared is going to be much lower.
Mm-hmm.
So, any questions about the EBITDA?
No, that makes sense.
All right. So we see how income approach and market approach. So you can use market approach. I think it's probably the more intuitive and the easiest way to do this when you're evaluating a business as a potential buyer and looking at businesses as potential targets. Probably the most user-friendly way is to use a multiple of EBITDA and just get to adjusted EBITDA. So do you want to talk now, Brady, about anything else? I know we've got some topics. Is there anything else we need to cover before we get to those other topics?
The only thing I can think of is if let's say the two don't agree. Let's say there's a spread, right? And the market comes in like somewhat different, but enough to cause you concern. What do you typically weight as a heavier indicator?
I'm typically going to weight the income approach more because the market is it is a snapshot of what similar businesses sold for, but it's not an exact replica, as every business is different. Even another equipment dealer in Florida would be different from this particular equipment business.
Yeah, and I think that makes sense to. Go ahead. Sorry.
You go ahead.
Okay. I think it makes sense to me. I was trying to translate it in my own terms, and Jim, we look at commercial real estate quite a bit, and we also tend to weigh the financial analysis much heavier than, let's say, a market analysis. I kind of look at market as, I guess the word I would use is market sentiment, like it's kind of the feeling of the buyer, if you will. Yeah. Whereas the financial side feels more robust. So I guess it kind of makes sense what we said, at least if I translate it in my own terms of how we would look at something, not necessarily, one-to-one, but very similar evaluation, maybe even in commercial real estate where you rely very heavily on okay. Yeah,
yes,
it makes sense.
That's a great point. So there are instances where the market approach, we would weight it higher. Like if we were valuing a Burger King franchise and we had 20 Burger Kings that sold in the last 3 or 4 years, we would probably weight the market approach higher. We would start looking at our income approach if there was a big difference. And but the big differences that I see between the income and market approach tend to be because with the income approach, we can take into account things like CapEx, whereas the EBITDA, and this is a great example, this is a business that has a high level of CapEx and $200,000 a year annual CapEx. And CapEx means capital expenditures for anybody who's not familiar with that. But so if, CapEx, if we were too far apart between the income and the market approach here, I would have weighted the income approach higher because of CapEx by itself. Because with EBITDA, you're just taking EBITDA and you're multiplying it by a multiple that you get from the market, but you're not accounting, you're adding back depreciation, but you're not accounting for the fact that you're going to have to spend $200,000 a year replacing the equipment. So that's an example of something that I've seen that can skew a difference between the market approach and the income approach.
Yeah. So market's more indication based. Are we in the right ballpark? Is there something, whereas the income is more definitive? Yeah, is what I'm hearing.
Yeah, unless you've got market multiples like a Burger King, or if you're valuing a ServPro franchise, or you're valuing, let's say, a veterinary practice, and you've got 50 veterinary practices, or CPA firms. A lot of times those types of businesses are going to be so similar. But when you're talking about this, an equipment, rental dealer, we're going to rely more on the income approach.
Okay.
All right. And so that takes us to the bottom line. Again, we ended up weighting the income approach. So another question that we were going to talk about today was what makes some businesses more valuable than others? Is it strictly cash, like EBITDA, or are there some other factors? And is now a good time, you think, to talk about that, Brady?
Yeah, I think so.
So some of the things that can make one business more valuable than another is, like in the example we're talking about here with this equipment appraisal firm, All Star Equipment of Gotham City. This particular business had a lot of customers. Its customer base was in the hundreds. But if we would have done, during our due diligence, if we would have found out that they really focused on municipalities in Tampa, Florida, let's say this, I can't remember if it was in Tampa or another city, but let's say it was in Tampa, and they did a lot of work with the city of Tampa, the county of Hillsborough, which is the county where Tampa's at, and they had a few other big customers, and we found that the biggest 5 customers made up 70% of the revenue. Then this multiple that we would have used probably would have been closer to the lower end, the 2.58. We would have probably been closer to that than we were to the higher 4.25. So, and which we would have also increased the risk rate we used on the income approach. So there is a component of the income approach called company specific risk. And I'm just going to go up here, diversification of customer base. So I would have added a significant amount of issue there had the top 5 customers made up more than 50% of the revenue. And especially if those top 5 customers, if I was dealing with one person at the county of Hillsborough, one person at the city of Tampa, one person with the power company, now if I've got, and 5 people potentially that if a buyer, for whatever reason, if one of those 5 or 2 of them or all of them decide, I don't want to do business with you anymore. I liked the seller, but I really was looking for a way out anyway. And now that you've sold the business, I'm gonna post this out for bid, and I'm just gonna go with the lowest bidder. Or I'm not even gonna post it out. I'm just gonna give it to somebody else. I like the seller of this business, but I'm really ready to move on from to another vendor. And so customer diversification is a big indicator or a big driver of value as well. Like, it goes into speaking to the quality of earnings. So you got the quantity with the EBITDA. The quality is looking at things like the customer base, how diverse it is. You may have other things like as we talked about earlier, like your secret sauce, like what differentiates you. Another differentiator would be key personnel. Do you have 4 or 5 people that if the owner is on vacation or sick, can 4 or 5 people that are going to be in the buyer's employ, are they going to be able to run the business? And the more you say yes to these things that are good and bode well for value, then the higher quality those earnings are, and that will drive the value higher.
Yeah. I have a follow-on thought as you were talking. So I actually have several, but I guess the one that's sticking out is, so in coming up with the capitalization rate or the cap rate, yeah. And also thinking through, let's say if this business was 4 times as big or whatever. Let's say they have, 3 million in EBITDA, yeah, or 5 million in EBITDA. Is that going to is the size of the company or the size of its cash flow or EBIT, is it going to dramatically affect the cap rate? In other words, is it going to push you fundamentally into a different position from like a multiple, as an example?
That's a great question. Once I would say from EBITDA of 0 to several million, it's not going to push the cap rate. It's not going to make the cap rate lower. It's not going to drive the multiple up much higher. The database that we pull these transactions from, we see it all the time. You can have businesses that are have revenue of $1 million and EBITDA of 250,000, and businesses with revenue of 20 million and EBITDA of 2 million that are selling for about the same multiples. So that shouldn't be a driver of multiple. I think until you get up into maybe the 5 to 10 million or more in EBITDA, and then I do think you start to see some increase in multiples of EBITDA. And I think that speaks to the fact that those businesses are likely going to have a more diverse customer base. They're more likely to have depth of management, more likely to have more key personnel, more diversification of product line, those kind of things that can play into the quality of earnings. And so I think it all goes back to the quality of earnings at that point. It just tends to be better. So it would still be on a case-by-case basis.
So Jim, I guess the follow-on to that would be, so let's say we're less than 10 million in EBITDA, right? So let's flip the table. So far it's kind of been buyer type of view of, or at least for me personally, it was kind of buyer view of the process. If I flip the table and if I'm the business owner now, and let's say a year from now, I know that I want to be in a position to sell. Yeah. And Wes may have more to add to this too, but let's say a year from now, I want to be in the best position I can be to sell. But how can I fundamentally change that risk factor other than just increasing income, right? Let's just say for whatever I have and whatever the path of year over year increase in profits, let's assume that continues. Is there a way that I can, let's say, better position myself to reduce this risk factor or multiple, whichever way you're looking at it? Yeah.
Well, I think there are some steps that business owners can take. And one of the steps that I would recommend is to try and delegate as much as possible to your key personnel. And if you don't have key personnel, develop them. And if you're not delegating to the key personnel, begin to. So that would be one place I would start. It's a real inexpensive way to increase the quality of earnings. Another item that I would look at would be my customer base. and trying to look at that and take a look to see if I do have customer concentration issues. If I do, then I may try to develop even more relationships with the same customer. Like if I'm dealing with, let's say Procter and Gamble is my big customer, and currently I'm dealing with one department leader, I may try to get to know more department leaders within Procter and Gamble, or I may try to get to know department heads in other departments at Procter and Gamble. So those are a couple of fixes that you could make. Another one would be try to do. Let me get my thought. To develop your recurring revenue stream. If at all possible, within your business structure, try to encourage your customers to some kind of recurring model. Mm-hmm. And that's not always possible. But that would be another way of increasing the quality of earnings. So I think a big test that an owner can give themselves is, are you able to take 2 weeks of vacation, or at least 1 week, and leave your business and it operate with your key employees? And if the answer is yes, then you're on the right trail with quality of earnings and with being able to sell your business. If your answer is no, then I think you want to begin to try to delegate enough to where people can run your business when you're not there. Mm-hmm. Because what a hypothetical buyer is looking for and what a hypothetical seller has to sell is the cash flow. And so the less effort that the buyer has to put forth to recognize that cash flow, the more valuable that cash flow is, and also the more stable the cash flow. So the stability of the cash flow is critical. And so anything you can do to stabilize the cash flow and to decrease the risk to the market, as a seller, that's what you have to sell. You're selling that cash flow. You think, in this case, you think you're selling the equipment rental, the equipment that's for rent. And you are, it's included in your business, but you're really selling the $230,000 a year. That's really what a hypothetical buyer wants to buy. Mm-hmm. So the less that a particular buyer has to get involved with the day-to-day in order to make that 230 happen every year, the more valuable your business is going to be.
Yeah, Jim, let me interject real quick, because this is what I do for my business owners. What I recommend is we need to know where we are today, because what happens a lot of times, and Jim, you've seen this, you have a situation where there be health, whether it be burnout, could be competition. People are coming to you saying, hey, I'm ready to sell now. And what you need to do, in my humble opinion, is prepare minimum 3 years out. And the way you start is by getting the evaluation, because there's a lot inside of what we've gone over today, or you've gone over today for us, that if you have professionals like they're on this call to assist with, you can increase that long-term goal quickly. But you've got to have people in place, because what happens a lot is you get busy in the day-to-day. And Jim, you've alluded to it, right? You build something up and you continue to do the same process you did when you're working 5 years in the business, right? Because you never took the time to take that initial step back to hire on the right people to go and grow. And so now you're still operating at the level you were 5 years into. Now you're 25 years into the business and you're burnt out, or health is hit, or the wife's saying, we got to go, I'm done. And you haven't put things in place to make your business what it could be worth. And so if you get that evaluation done and planning, start to implement processes to allow that cash flow to be easier than for you to have to constantly be in the business working on it. Take that 2-week vacation, as you mentioned, right, as a test. You're increasing that value substantially.
Great points, Wes. And I'll just segue on or piggyback on what Wes said. The processes. Another thing that can help with business value is documentation of your processes. So it's one thing for everybody to have processes up here, but it's another for somebody to have them on paper, and for a buyer to come in, the seller, that's part of what you're going to have to sell is, hey, I've got secret sauce, and not only do I have secret sauce or secret trade processes or trade advantages, I've also got them written down. I've got what we do in order to have this advantage is written on paper. And so another thing is just your business logo, your presence on the internet. One customer that we valued, his business, he was in the poop pickup business. So think, HOAs, and you have your poop pickup station. Well, his business was to go around and have contracts with HOAs, and he picked up poop. And his slogan was one of the best I ever heard. It's business stinks, but it's picking up. So, those things, documenting your processes, getting a valuation done, like Wes said, I think you do need 3 years would be great. 5 years will be even better. To start what you might call succession planning and starting to talk about these things. Give experts like myself, Wes is also an expert in that area. And we've worked with another guy named Scott, who's a friend of ours, who's a CPA. And Scott does, he can go into a plant and help people make sure that their equipment's laid out correctly. And through cost accounting, he can determine if your labor costs are, maybe higher than the industry, and your inputs, and your maybe sell some of your byproduct and things of that sort. So, Wes, that was a great point.
Yeah, I think you touched on all the points I was curious about. I got a lot of good notes on my side screen here. Yeah, much appreciated. Yeah, I think that's it, Jim. I guess maybe final question on this, the quality of earnings number, or the COE capitalization rate. Like, how much does this really vary business to business? Is it huge? Is it, some are 10, some are 12, or is it 10 to 20? Like, I'm just curious for my own knowledge, how big of a variation is that? Because that's really depicting the value of the business as a whole, right?
Well, first of all, I want to tell you that the equity return you should get should be higher than publicly traded stocks. So if you notice here, my cost of equity in this scenario was 15.5%, which means that I believe whoever buys this business on their equity injection should get a 15.51% return, which is greater than the smallest publicly traded stock returns. Mm-hmm. Smallest publicly traded stock. But then at the time we did the valuation, we recognized weighted average cost of debt. The debt to equity structure that we from the market we gleaned was sustainable was 77% equity and 23% debt. So when we looked at the cost of debt at the time, debt was only going to cost, it was 6.5% was the rate, the stated rate. But when you're only going to have 23% of your capital structure as debt, and it's only going to cost you 6.5%, but that's before tax, which is a 5.14 after tax. Now you're talking about 23% is only going to cost you 1.18%. Well, that was a few years ago. This cost of capital has gone up since then. Mm-hmm. And so the equity should always be 15% or greater, the return on equity. So if you're putting down $1 million, you're going to want to get a return on that equity that is commensurate with the risk. And the risk is, 15% or more. And So that's, you won't see it go below much lower than a 15. That's a pretty low equity because this was a very stable business. It was rental equipment, as we mentioned earlier, and it had a lot of customers in a busy Florida market. And as we all know, Florida is a booming demographic. Rental equipment is not as susceptible to recession as, say, some other construction related businesses. And so this business did have a pretty low cost of capital.
Yeah, I would hope if you're putting your equity in that you'd do better than 15%. I guess. Yeah.
And really, as a buyer, you want to get at least 15%. And I do have a justification of purchase price that I'm going to scroll to just to show you how you may test this out. Is you go to a scenario. If I put 20% down on this $2,030,000 business, and I get an SBA loan or 80%, and this particular loan, I knew the rate. The market rate was 6.5%, but I knew that for this particular loan was actually 6% for 10 years. And so we looking at the projected earnings before taxes of 262, and then accounting for interest on the note, the $1.6 million note, the projected available cash flow was 210,000 after taxes, after all the expenses, and on the $406,000 equity injection. So there was quite a return on this equity injection. But of course, right now, this interest rate, I believe it was variable. And so now that's probably up to 10.25%. And so this number is much lower. And that's probably what you've seen in the rental real estate market, the investment real estate that you were in. It didn't that kind of squeeze this cash flow.
Yeah, very, very similar, right? We kind of look at return on, or, I would say internal rate of return, which is, let's say, a similar thought process, right? Over time, your time value of your money, or even annualized return sometimes. And yeah, the result is the same. It pinches the purchase price, right? It makes it so that to get your desired return, right, you have to lower the purchase price. It's the same effect.
Yeah. So inflation, we may have touched on this earlier. Inflation does have an effect on market multiples, even for small publicly held or privately held businesses. So it tends not to fluctuate as much. And I won't go into the detail, but I did a study a few years ago and presented it to at a bank conference. And it's about 5% plus or minus as interest rates. I looked at what happened when the Fed increased interest rates in 2006. And again, when they started increasing interest rates in 2021. And what happened is multiples went down about 5% or so. So it's not a huge difference, but the multiples don't change much anyway over time. So the multiples tend to be between 2.5 and 5 for privately held businesses. And, with the most sustainable businesses, the ones with the best quality of earnings being closer to 4, maybe even a 5 being really high. And the ones that have very little sustainability, like think of a chiropractor or another kind of worker or own business owner that works with their hands. If I go to a chiropractor, I believe that chiropractor's hands are what's helping me. And I don't even want to go to their associate, because if the chiropractor I go to has 3 employees that are all chiropractors, I still want to go to the chiropractor who helped me with my neck problem, not the chiropractor over here who is his associate or her associate. So those businesses like chiropractic tend to sell, even below the 2.5 times EBITDA.
Interesting. Yeah, and interesting, and it makes sense. Yeah.
Yes.
Nice. Yeah. Thanks, Jim. That was I think the assortment of my questions. Thanks for
all right. Well, I'll
Wes, I don't know if,
Wes, do you have anything else to add before I wrap it up?
I'm good on my end. Thank you, guys.
All right. So for Brady Hochpower and Wes Haney, a couple of friends and also a couple of potential investors who are looking to buy a business. I'm Jim Turner, the Biz Value guy. So until next time, we'll see you later. Thanks.